Let's head to Chicago now and talk to Alan Nuckman. He's Chief Market Strategist at Bullseye Options. Alan, good to see you. I know one thing you're looking at this morning, and we've talked about it a couple of times here on the show, is the monster tax bill that Apple has now been handed by the European Commission. Apple stock is down in the pre-market. Is this really material to the stock, do you think, or is the settlement of this thing so far out that it wouldn't really be material at this time?
Yeah, we're talking about Apple. Those guys know how to make money. They've got a lot of money. This is chump change to them. And the stock's only down, a little bit here, down nearly 2% the last time I peaked. But let's remember that Apple stock has come back and it's back above $100, and it's up 10% in the last month or so. I think this is a needed little pullback. But the NDX still remains strong. That obviously is what's holding down, because Apple comprises about 10% of the NASDAQ 100. That's what's holding that market back here this morning.
You're also watching the VIX and volatility very closely. What are you seeing there?
Well, VIX is something you always have to keep an eye on, and it's still trading sideways. We get these periodic bumps up, these VIX explosions, and we got nearly to 15 the other day, and then it got whacked back down. But yesterday was interesting in the fact that the volume was so low. It was about a third of what it typically does as far as VIX options traded. So in the bigger picture, in the last month or so, we've been trading between 14 and 12. So let the market tell us on a weekly basis if it's going to break out either direction. But the big but here is there is a caution. Back on August 9th, the market made new lows and then closed higher on a weekly basis. So that's a key reversal. Doesn't mean as much in the summertime, but we haven't seen the markets really have any good follow through on the upside. And we've seen this kind of caution sign being held up in the VIX market.
So, Alan, it's been a very quiet week for investors, but there is the jobs report coming out this Friday.
Right.
What do you expect the market reaction to be, and could that be something that actually creates some volatility in the markets?
Well, as you well know, there's a holiday on Monday, so this is one of the weeks to end the summer here. So you can probably feel it, like I alluded to, in the VIX option volume is not robust, shall we say. Not to say there's not opportunity. There's always opportunity in the marketplace. It doesn't matter. The markets aren't good or bad. They just are. I'm not putting that much stock in the unemployment number, but people will focus on it because, again, we're on Fed watch, and we continue down this road. The probability of a rate hike has increased to about 30% in September. I think that's a little high, but it is 60% in December. That's more realistic. But let's remember, it's not about predicting the rate hike. It's predicting how the market's going to react. And we had that one rate hike in December, and it wasn't catastrophic. And another rate hike actually could be viewed as a positive sign.
How would you expect the market to react if we do get a September rate hike?
I don't know. I'm still very optimistic, and a quarter point is not going to have any impact on the choice between treasuries or looking at the yields you get in the stock market. I think there will be people that'll be spooked, but I would look for that to be temporary, just like we've seen every other sell-off in the last 7 years to be temporary, come back, make new all-time highs. Now, let's see how things develop. There are a couple of things that I like at these levels, but it's all about the dollar. We've obviously had a big comeback, and we're very, we're within striking distance of the all-time highs. It comes back to the U.S. dollar. The U.S. dollar is back above 95. It's firmed up. The euro currency is back below 112. So I think this is an opportunity. If you look at some of, you're obviously Canadian, the metals, the miners, you look at something like gold and silver, they've come back down to the low end of their 2-month range. So from a risk-reward standpoint, I think there are a lot of stocks in the sector that are giving us a second chance after they had that straight up from that bottom in January.
So what about the financials? You've been seeing the financials starting to come back a little bit in the last couple of weeks after lagging the market earlier this year. Do you see that trend continuing, and would that tie in with the rate hike possibilities later this year?
Yeah, I'm very optimistic in XLF, the financial ETF. For the long term, the banks never recovered to the extent that the rest of the markets did, made new all-time highs, obviously, in every other index here just recently. So there's still, from a risk-reward standpoint, I'm looking for these banks to participate. And I do like your analysis earlier that I was listening in, that talking about this additional volatility that we saw with Brexit. Who makes money on that? The investment banks. So let's see if they can surprise. They're the first guys that come out with earnings here in October. So we've got kind of a dead period. Not only is it the end of summer, but we've got a dead period with we don't have a whole lot of fundamentals until October. But the banks kick that off. So let's see if their numbers surprise or at least don't disappoint. Surprise there with additional earnings from trading in that last quarter.
We spent a bit of time talking about emerging markets today. Very briefly, do you see opportunities at this point in emerging market equities?
Well, I did months ago when they'd been beaten up because of the dollar scare, when the dollar was strong, but now they've gone straight up and they're at year highs. So from a buying standpoint, yeah, the EEM could still get to 40 very easily. That's my target after the breakout above 36, but you know, it's been straight up without any real corrections. Again, the function of the dollar, but if you look at the dollar, I think that perceived strength that we had months ago has dissipated, and it's not going to be a fast crank or rise in the dollar. It'll be more symbolic when they do raise rates, and even a series of rate hikes over a short period of time still gets us nowhere near the normal Fed funds rate, which is about 4.5%. So we've got a long ways to go, and it's going to take us a long time to get there. So the rate talk is a fun discussion to have with you every time we chat, but I don't think it's going to have a material impact on the market. I still think there are great opportunities out there. You've got to look at pockets of stocks that haven't participated. Now we've seen the NASDAQ catch up, and the NASDAQ's now within, up there as far as the performance goes with the S&P and the Dow. So, that was the pocket we talked about a couple weeks ago that it had to play some catch up. Keep an eye on somebody here that's really interesting, I thought. GE. It takes a lot to turn that ship. But GE has been going absolutely positively nowhere for the last month, trading in a dollar range. So 36 is the next upside target. I think that could play some ball. It's unchanged in 2016, whereas the Dow's up 6%. So, I don't think you can go wrong. I don't think there's a whole lot of risk in GE at these levels.
Alan, always great to talk to you. Enjoy your holiday Monday.
Thank you, Paul. You too.
Alan Nuckman, Chief Market Strategist at Bullseye.